The market could be back on track from its huge bear market sell-off. As of yesterday, April 22nd, 1.5 trillion was added back into the stock market after Trump stated he has no intentions on firing Jerome Powell. He also stated that the tariffs on China will be eased back significantly. Huge sigh of relief for the market. The last 6 months, the S&P has been down 11.84%. The Nasdaq has been down 12.63%. And the Dow Jones has been down 11.08%, all below its 200 moving average. Not the best start for the market at all this year, all due to the tariffs and the rising concerns of recession. Technicals have been hit very hard due to this, but we haven't really seen the damage done to fundamentals yet. It's very important to stay on top of earnings as earnings season has arrived. Historically, the PEs do rise during times of recession. The Russell 2000 index has a current PE of 31.96. Year ago is at 27.05, so increase there. The Nasdaq 100 index has a current of 27.15. Year ago it was at 30.78. And the S&P 500 has a current of 21.37. Year ago is at 24.36. So no signs of a increasing PE due to recession for the Nasdaq and S&P 500. The Russell 2000 may be urging towards it, but not very convincing. The Russell 2000 usually has a higher PE due to its focus on small cap businesses. Over the past year, the PEs for the Nasdaq and the S&P have been very high valuation, but right now it has come down a little bit. Good time to buy. Little lower valuation, something that was needed for the stock market. Now, a huge decrease maybe was not needed. Certainly, we did not know that was going to come, but it did, and we're here now, so we just need to navigate through some of the uncertainty. Important to stay on top of the Mag 7 companies and their earnings. Yesterday, Tesla reported earnings after the market closed and had a negative earnings on the earnings per share side and the revenue side. Google Alphabet reports late on Thursday, April 24th, with a estimate of $89.23 billion for its revenue and a estimated earnings per share of 2.011. As we start to see the Mag 7 companies report their earnings, and other companies too that you guys may invest in, we can certainly see if the fundamentals have been hit hard. But nothing yet. Some of the economic fundamentals did get hit hard month to month, but they could still regain strength for the end of the year. Now, Powell and Trump are going hand to hand. Well, more Trump's firing at Powell. Monday, Trump posted on social media stating the U.S. economy would slow unless Powell cuts interest rates now. I made a video on this a while ago, but there's a theory circulating around that Trump is purposely crashing the market, so the Feds have no other choice other than to decrease interest rates so that the debt that the U.S. government has to refinance this year is cheaper. Last week, Powell warned on Trump's tariffs on the economy and stated the Feds would take a cautious approach to reducing the rates, so maybe a little bit of an urge towards a rate cut there. And then Trump stated Powell's termination can't come soon enough, also called him a big loser. This is just ridiculous for Trump to do. Powell has done a tremendous job in the last 2 years, in navigating the very high inflation rates, and he did not get us into a recession. So Jerome Powell is certainly a very strong and capable head chairman for the Feds, and I do not believe that he should be terminated at all. He's done a tremendous job for us in the economy. It's important to note, though, the Feds don't really help the economy. They just try to navigate it through inflation and interest rates. But they certainly do have quite the influence on what happens with the economy. But now on Wednesday, Trump is reiterating his statement, and now he has no intention on firing Jerome Powell, which, like I said in the beginning of the video, is a huge sigh of relief for the market. In terms of interest rates, I think if Trump continues his aggressive approach on tariffs, the Feds have no other choice other than to decrease interest rates to try to regain some strength in the market. But the main worry is the tariffs. It's been the tariffs. Interest rates are just something that came along with it because Trump crashed the markets through his tariff plan. Now Trump's stating that he's going to ease back on tariffs through China, like I said in the beginning of the video. I don't think the Feds really have any worry there now if Trump really goes through his plan with easing tariffs on China, and I think that the Feds should really just keep interest rates where they are. So there's always something you guys could invest in during times of uncertainty, even if the market's going down. Right now, bonds aren't the worst to look. If you're looking for more safety during the bear market, bonds could definitely offer that. The Vanguard Total Bond Market ETF BND is a great start. Pays a solid and stable dividend. Dividend is the interest paid out by the bonds, meaning you want a pretty good interest rate or coupon rate that they got for the bond. The coupon rate is fixed, so it stays the same over the entire period. Right now, the ETF has invested in some very high coupon rate bonds. So very strong dividend for the end of the year. Could ride that out and have a very good, stable, fixed income. The ETF also has a low expense ratio, which is a very important thing, and an extremely low default risk. Default risk is the ability for the borrower to pay back the bond on time. Now, I heard in one of my podcasts, the Halftime Report by CNBC, that a lot of large institutions and banks are now maybe focusing some of their reserves into gold. Gold's a very strong asset. It's able to keep its value a lot more stable than bonds or stocks. Right now it's very overbought, but it's had great growth. A year ago it had a 46.39% gain. So gold's definitely something you should look at and certainly will increase in the future. A lot more ETFs too are good to look at, and I'm going to make a separate video on that coming later this week. So I hope you guys enjoyed the video. Drop a comment, subscribe, and like. Thank you.